This presentation is on Chapter 12 from More Than a Numbers Game. Presenters are Jenny McConnell and Margaret Seelock. My name is Jenny McConnell. I'll be presenting the first half of the chapter. Margaret will be presenting the second half of the chapter. In this presentation, we're going to go through options. We're going to explain the options to ensure that you as a viewer have a better understanding of what they are. We're going to talk through some examples for business professionals, discuss why use options, talk briefly about convertible debt. Then Margaret is going to go into a history of stock options, calculating stock options, do an overview of reporting issues, and also present an example of a compensation expense. All right, now first off, let's ensure that everyone has a basic understanding of what options are. So what is an option? An option is an opportunity to buy an asset without the obligation to buy that asset. In other words, you have the right of first refusal should an asset come up for sale. There are three common types of options. There's stock options, which folks are likely most familiar with. There's bond options, which are more prevalent in the financial sector, specifically with traders and investors. And then there's real estate options, which generally relate to land. We're going to go through each of these common types of options throughout this presentation to help everyone solidify their understanding of options. The second half of the presentation is going to cover primarily stock options. Additionally, there is a handout that goes along with this presentation that goes into some more depth about stock options that we encourage you to spend some time reading through. There are also a few key terms that relate to options that everyone should be familiar with. The first is the strike price, also known as the exercise price. It is the agreed to fixed price for the asset. So should that asset be sold, or should you choose to exercise your option to purchase an asset, the amount that it would be purchased for is the strike price. There's the grant date, and that is the date you're eligible to purchase the asset, and the expiry date, the date the option to buy expires. Now, in addition to this basic information, anytime a contract is negotiated, it's imperative to clearly specify the terms and conditions of the contract, including the strike price, the grant date, and the expiry date. And we're going to see an example later on with the Monte Cristo property here in Alaska on why having those terms and conditions specifically outlined is very important. Now let's ensure that everyone has an understanding of what a stock option is. So let's say, for example, that you went to work for a new employer and you received the option to purchase up to 10,000 shares of your firm's common stock as part of your compensation. Now, the market price and exercise price is $20 at the grant date. The option is good for 10 years. Now, initially, since market price equals the strike price, you would not want to redeem this option, and in fact, you might even think that it isn't valuable. Now then let's look further down the road, and at the end of the fourth year, the market price is $30. All of a sudden, you have the ability to earn $100,000. So let's walk through this. So here on the right is a breakdown of what this calculation looks like. So we have 10,000 shares that you're eligible to purchase. You have a strike price of $20 per share. So the cost to you would be $200,000. Now, 4 years later, we have a new market price of $30 a share. So if you were to purchase these stocks, up to 10,000 stocks, you would not pay the $30 a share. You would pay the $20 a share. So even though there's a value of $300,000, you only pay $200,000. Therefore, you automatically have a value of $100,000. Now, bond options are more prevalent in the financial sector, but given that this is a general Masters of Business program, it is important to understand, or at least recognize, that there are different types of bond options. So let's take a look here at a couple of bond option examples. You have what's called the bond call, and we have what's called the bond put. The bond call is when the option holder has the right to purchase the bond at the agreed upon strike price, whereas the bond put is when the option holder has the right to sell the bond at the agreed upon strike price. So let's take a look at the bond call example first. So let's say that you agreed to a bond strike price of $950. The bond security is $1,000. If interest rates decrease, the value of the bond increases. Given the bond's value increased and the strike price is $950, you can buy the bond for $950, thereby earning a value or earning a profit on that bond. Now, the inverse is true for a bond put. So as we just mentioned before, the bond put is when the bond option holder has the right to sell the bond at the agreed upon strike price. So here, you've agreed to a bond strike price also of $950. The bond security is $1,000. Now let's say that interest rates increase and the value of the bond therefore decreases. If it decreases below the $950, you can sell the bond for $950, and the amount between the decreased value and your $950 is your amount earned. So when we say the amount between the decreased value, let's say, for example, that the bond value decreased to $900, and then you sold the bond for $950. So your earned value is positive $50. Now, as I mentioned at the beginning of this slide, bond options are primarily used specifically in the financial sector with traders, investors, but it is important to have a basic understanding of what precisely bond options are. Now let's look at a couple of real estate examples. These are specific situations that you may potentially encounter when you are working in the business world. So for the first one on the left here, let's assume that you're an advisor for Alaska Small Business Development Center. Your client is negotiating the purchase of an established mechanic shop. Your research shows the owner also owns a second plot of land next to the shop. Your client may potentially want to purchase this land at a later date. You encourage your client to include a real estate option that states your client may purchase the property for a specified price if the owner sells by a specific date. So in this situation, you have added value to your client by ensuring that your client was made aware of this land and had the opportunity, but not the obligation, to purchase the real estate in the future should it come up for sale. Now, another real estate example here is something that is actually ongoing here in the state of Alaska. So there is a company called Great American Minerals Exploration, and it's suing Samuto Metal Mining America for violating an options contract. Samuto sold Pogo Mine and its Monte Cristo property to North Star Resources in 2018. So the Great American Minerals Exploration Company stated that in 2016, it entered into an options contract to purchase Monte Cristo if it completed outlined work and payment requirements by 2019. So again here, the Minerals Exploration Company is asserting that it had fulfilled the contracts, so it was inappropriate for Samuto to sell the Monte Cristo property to North Star Resources. Now this matter is currently in litigation. but it is valuable to be aware of because, as we mentioned earlier in the presentation, the terms and contracts or terms and conditions of a contract should be specifically outlined to include the not just the strike price and the purchase by date, but any sort of details that go along with it. This way, those matters can be resolved for the future. So I use options, leverage. When we went through the three common types of options, we talked about stock options, bond options, and real estate. So first, let's look at stock options. Why would you potentially use stock options? One reason to use a stock option as part of your compensation package is to attract talented employees when your company may not be able to pay attractive wages. So another reason to potentially use stock options is also for retention purposes. So for example, one company, the Cheesecake Factory, they utilize stock options for certain subsets of their employees. So how they've designed these stock options is they vest over 5 years, and as vesting goes along each year, the stock option becomes more and more desirable, therefore encouraging those employees to continue to stay with the Cheesecake Factory. So here they've been able to increase the value of the compensation package, while at the same time they have utilized stock options to increase retention as well for their organization. As for bond options, as we mentioned before, those are generally used in the financial sector by investors and traders. Now, savvy investors and traders are able to mitigate fluctuations in bond prices through strategic utilization of bond options. And now, an option or real estate options, they secure an opportunity for yourself or your business for the future. And we did talk about a couple of examples in our prior slides. Now, in addition to stocks, bonds, and real estate, another option is known as convertible debt. Now, convertible debt is when money lent by a company or investor to another company is transformed into equity rather than just repaying those lent funds to the lender. So let's talk through an example here. So let's say that your neighbor is opening a new brewery. Your neighbor is a talented brewer with strong business acumen and is well connected in the community. You have reason to believe that this will be a successful venture. Therefore, you offer to support your neighbor by contributing capital to your neighbor's brewery. In exchange for the capital, you receive equity in the brewery. So this would be an example of convertible debt. That money that you lent gets transformed into equity into an organization. So now at this point, we have covered stocks, bonds, and real estate options, and now convertible debt. You have a basic understanding, foundational understanding of what options are, and Margaret is going to go through the second half of the presentation.
Hi class, this is Margaret, and I'm going to give you a brief history of stock options as it was presented in More Than a Numbers Game. We're going to start off with the class of 1986, the Internal Revenue Code 162 Section M, the 2002 accounting downturn, which inspired the Sarbanes-Oxley Act, and lastly, the FASB Statement 123 revised. First, I want to talk about the class of 1986, and this refers to the thousands of employees of Silicon Valley tech companies that went public in 1986, such as Oracle, Sun Microsystems, Silicon Graphics, Adobe Systems, Informix, and Microsoft, that became millionaires as their employer stock prices rose. So this made me wonder, where was Apple in all this? When I think of the 80s and stock you should have invested in, it would have been Apple. So I went and found Apple's story, and they went public on December 12, 1980. More than 40 of their 1,000 employees became instant millionaires. The stock was filed to sell at $14 a share, but ended up opening that day at $22 a share and sold out within 10 minutes. That day alone, the stock rose 32%, closing at $29 per share. Apple's largest shareholder, which you all know, It was 25-year-old Steve Jobs, who ended the day with a net worth of over $217 million. And then next we have the Internal Revenue Code 162, Section M. This was a 1993 revision that placed a $1 million limit on the amount of deductible compensation expense a company could pay their CEO, CFO, or other 3 highly paid executives. Prior to 2018, there were 2 very notable exceptions to this limitation. 1, performance-based pay, including stock options, and 2, commission-based pay. So companies use stock options as an additional incentive for executive teams. More Than a Numbers Game was published in 2006, so there is more to the story. The Tax Cuts and Jobs Act of 2017 repealed these exceptions and placed a flat $1 million for total compensation for executives. The Internal Revenue Code 162M was the tax code blamed for the rise in CEO compensation. Moving on to more history of stock options, FASB Statement 123 was put out in 1995. This came after many years of discussion and debate over how companies should value and expense options. Employees feared that their companies, if they were forced to record an expense for options, that they might hesitate to distribute future awards. Recently hired workers would not share in the windfall enjoyed by the class of 1986 or Apple. In March of 1994, thousands of people met outside the San Jose Convention Center to protest the accounting proposal. This is the first mass rally against an accounting standard ever. The FASB felt this opposition might threaten their ability to work with constituents and issued Statement 123 as a compromise. Employers had a choice to 1, expense options over an appropriate vesting period, or 2, disclosure of pro forma earnings had the options been expensed under the fair value method. This caused a problem because companies were reporting this expense differently. You would not be comparing apples to apples, but apples to oranges. Moving on to the accounting downturn of 2002, I'm sure you've all heard of Enron, Tyco, and WorldCom in the early 2000s. Because of stock options, employees were preoccupied with short-term movements in their employer stock prices to exercise options and make a profit. This incentive encouraged fraudulent activities from employees to inflate earnings in the short term so they could cash in. The response to these scandals was the Sarbanes-Oxley Act of 2002, which, More Than a Numbers Game, goes over in Chapter 14. This act aim was to protect investors from fraudulent reporting by corporations by reforming regulations and imposing tough new penalties for those who broke it. But I won't get into that, since that is a whole presentation on its own. And then finally, in December of 2004, the FASB circled back around and finally dealt with the option valuation issue once and for all. This statement required companies to value option grants with pricing models and expense them over the appropriate service period. The accounting change would cause earnings per share to be reduced on average 13%. But after all was said and done, there was no significant consequence of expensing options on company stock prices. To everyone's surprise, investors showered them with love and overall had a positive reaction to the transparent reporting of stock options. It's kind of puzzling why some companies continued to fight implementing Statement 123R. So here is a quick example of what I was just talking about with expensing options and the reduced earnings per share. On the left, we have a simplified income statement that does not expense unexercised options on the income statement and shows disclosure. At first look, $10 earnings per share looks pretty good. Then looking at the company on the right that chose to expense the unexercised options on the income statement, their earnings per share was $9 per share. These companies had the same exact financial situation but were reporting it differently because FASB 123 allowed them to make a choice. FASB 123 Revised took away that choice and required all companies to expense. Investors were not afraid of this change, and it actually made evaluating financial statements easier because, again, now we're comparing apples to apples. Moving on to calculating stock options. In the chapter of More Than a Numbers Game, they highlighted the Black-Scholes option pricing model. In 1973, Fisher-Black and Myron-Scholes used a calculus and physics heat transfer equation to solve the problem. The model takes into account 5 things. 1, the strike price, also known as the exercise price, 2, the current stock price, 3, time of expiration, 4, risk-free rate, and 5, volatility of the market. For the first time ever, accountants had a valuation tool to use for options. This was very exciting. So exciting, it won the Nobel Prize in economics. But unfortunately, the Black-Scholes model is used in Europe because the model made certain assumptions that don't work for US companies, such as no dividends are paid out during the life of the option, or the assumption that options can only be exercised at expiration date, where here in the US, options could be exercised before the expiration date. So the question remains, how does a company fairly represent the value of an unexercised option? We've already gone over the Black-Scholes pricing model and how that can't be used here in the US because of specifics in the model. But it was very important because it showed everyone that options have value that can be estimated, so they should be estimated and expensed. For a while, companies were using the intrinsic value method, and that was before FASB 123R, where companies had the option of which valuation method they were going to use. In the intrinsic value method, for example, you're given an option for $20 and the market price was $20 on the date of the grant, so the company would record no expense. Then there's also the fair value method, which uses an acceptable option pricing model to value the options at the grant date. These models take into account several factors that determine the option's underlying value. This is the current method that is required after FASB 123R.
Now, to summarize what we've discussed in this presentation, first we started off by going through options. We talked through stock options, bond call, and bond put options. We talked about real estate options, and we talked about convertible debt. Margaret also walked us through a little bit of the history of stock options. It did take about 75 years of discussion, debate, and adjusting requirements that have shaped the current requirements for reporting options on financial statements. We can now recognize that options do have value and that value can be estimated. Therefore, it is appropriate for that estimate to be expensed as compensation and expensed over the appropriate service period. Furthermore, there are fluctuating variables, subjectivity, and a lack of reliability that does make calculating options a challenge. However, as was outlined by FASB 123R, the fair value method is the current method for calculating options. We thank you for the time that you spent reviewing this presentation, and should you find yourself interested in learning more about options, the following is a list of references used to put together the information in this presentation.